Jigar Mistry is now joining us. He's, of course, with Buoyant Capital. Jigar, it's been a while since we spoke. Thanks very much for your time. Good to see you here. So what are the smart folks at Buoyant doing, Jigar? Are you sitting on a lot of cash? Are you all in? Did you go? I mean, just tell us a little bit about what you've done, because I mean, we had a momentous week, the last one, with very large moves, I mean, it's not as if things were not looking good before, but now it's kind of entered into another realm in that sense. So what have you been doing?
Yes, good afternoon, Prashant. Thank you as always for inviting me on your show. I think you'll take a step back and realize what all has transpired. Right? The first thing is that BJP secured a reasonably good win in 3 states. But go back and check, you find that there were some 224 seats where BJP had a 50% plus vote share, even in 2019. Secondly, you'll realize that the US yields have fallen from 5% to I think 4.19 at the bottom, 4.2 something. But there again, you go back and check and you realize that probably the interest rates are likely to stay higher for longer and not just high up and come down again. So if these two are the reasons why sort of the markets have done so particularly well, in fact, I was just checking the data before I came here. It was somehow very difficult to lose money in the last 6 months, right? So if you look at the data of the 1,500 companies, more than 500 crores in market cap, only some 60 of them are actually down. 250 are up more than 100%. And I think 3 of them are up more than 5 times in under 9 months. So I think it has been a great sort of run up to this. But, look at the rolling return data for, say, a small cap index, for example. Every time it has been in the 35% plus handle. It happened 3 times before 2007, 2011, and then 2017. The next 2 years returns have historically been a negative 35%. So while it is, the recency bias is great, and we are getting carried away, small mistakes can happen and that have very large repercussions. So our sense is that it's time, I've been saying it for the last 1 month or so, and the markets have actually done fairly well since then. But I think the easier thing to do is actually, sort of get a little more defensive in the scheme of things and take it up from there.
So to get defensive, are you booking profits in parts of your portfolio, and if yes, which ones?
Right. So we used to be almost 65% or small and mid cap exposure. After March, those stocks have done phenomenally well. And we have sort of taken all the incremental money, sold some of the older positions in small and mid cap, and are deploying a lot more in larger caps. Largely financials and banks, pharmaceuticals is where we find some amount of opportunity on an absolute basis. But that small and mid cap as a proportion for us has fallen below 40%, which was at peak, I think 60 or 65%. So one is the tilt that sort of we are following. The second clearly is in a managed account sort of scenario, which a PMS is. We are telling incrementally investors that will take time to fully deploy this capital, right? Because investors either try and time the market. None of us are good at doing that. So the better way to deploy capital if you are raising more is to, sort of spread this out over the next few months. And that way you don't really have to sort of see if it makes sense at this point in time or not.
So other than deploying the money that you've raised by selling your stake in some of the small and mid caps, other than investing it in large banks, is there any other place where there is relative comfort to invest at current levels?
Yeah, pharmaceuticals is reasonably good, but look at all the sort of sectors which are, doing well from an economic standpoint, and which go back and check what the market is forcing you to assume. We are increasingly getting into this too hard to sort of price in territory, right? Capital goods, a reasonably decent space, you're likely to see more orders. The valuation leaves a lot of sort of area for discomfort. Same way, like drones, interesting places, but hardly, if at all, any companies trading at very high valuations. New age tech businesses, again, they have moved, we had some exposure earlier, but incrementally to see a lot of them report 5,000, 7,000 crores in profitability to justify a 1 lakh crore plus market cap on a steady state basis is getting a little trickier. Not a lot of sectors. Specialty chemicals are seeing a reasonably good cyclical downturn, so at some point they might become interesting. But at this moment, very difficult to find opportunities to deploy a lot of capital.
All right. Hi, Jigar. Good afternoon, and good to see you. And we're speaking after a while. Jigar, in your earlier avatar, you were quite a master in the metal space. How are you all positioned out there? I recall we would have spoken in the past to get the last few months of the calendar right, and the early few months of the calendar right, and the full year you can go and just travel. If you get that timing, those 4 crucial months, then you're off to the races. This time around, how do you think things are panning out, and what is your positioning in the metal space?
Yeah, Nigel. So we used to discuss on how you should buy in November, sell in February, and just make hay while the sun shines later on. But again, see those sort of super cycles in metals, because the markets have become very, very sort of localized as we speak. It started with China earlier importing a lot of material, and therefore things were great. Then China started exporting, and all economies started creating virtual walls, right? So it started with Europe first, then US came in, then India put up the minimum import price. So I think all those spaces are where you completely localize the market. Demand supply from China became increasingly irrelevant, and that way you are starting to track local issues now. So for the past 2 or 3 years, I think that relationship we had created a very nice heuristic on sort of ceases to exist. In that scenario, it becomes sort of a case-to-case basis, right? There are times when a few companies here or there do offer some interesting opportunities, but with companies and sectors like metal, the best money is made when sort of the management has also thrown in the proverbial towel. That way, you're able to pick a lot of businesses at throwaway valuations and then generate return for 3 or 4 years, rather than trying to pick up the 20% upside. So today, it's not even our top 10 sector as we speak. Cement, on the other hand, is interesting, the other sector we used to talk about. And there, with the M&A picking up, that sort of looks like continue to remain an interesting bet.
On cement, you're like what? Large or mid cap or small cap? What is it? You believe there's more consolidation in play?
Eventually, there will have to be, Nigel, because see, you look at the current sector, it's a very unique sector in that there is a strategic discount on M&A, right? You have to buy, if you buy a large cap cement name that trades at a premium to the M&A deals that are happening, it's hard to find any sector where this is prevalent. So that way, you're better off as a secondary investor to buy companies which can translate into a sort of M&A candidate rather than picking up companies that would be acquirers. So long-term EV to EBITDA PE ratio still don't make sense, but that is sort of interesting space in the cement, especially sort of less than 6 months into the general elections as well.
Jigar, talk to us about one idea that you like and you're backing, with of course all the disclosure, etc. But something that looks interesting, and why?
Sort of the last time, Prashant, we did speak about 2 or 3 companies that we have added recently. Aavas Financial was one, RR Cable was another, ICICI GI was the third one. So I think within the sort of space, banking continues to remain the best possible play. I would say HDFC Bank, it's for the first time in 7.5 years that we have been running Buoyant, it's come to the top 3 positions, and I think that business, people have, it's sort of one step away from being a meme stock, and sort of once it acquires that status, the stocks tend to do fairly well on a lighter note. So I think HDFC Bank, given the consolidation, given the management changes, all of that is, I think, now behind, and we might be surprised over the next 1 year with what this seemingly boring stock can actually deliver.
Okay, and of course the others that you mentioned, RR Cable and the ICICI GI, etc. Those you still like, right? Aavas, etc. You still own.
Yeah, so that is sort of in October, the webinar that we presented as the 3 largest positions over the past 3 months or so.
All right, Jigar, we'll leave it there. Thank you very much for joining us on CNBC-TV18. Appreciate your time here, as always. I think we'll take a quick commercial break here with the news that Nifty is up about 30-35 points. We are exactly at 21,000. As we do that, we take that break. We'll come back. We'll get you what's happening in dealing rooms, D Street Chatter with Nimish coming up in just a bit. Our technical trading ideas after that. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence.
For more news and updates, all you need to do is follow CNBC-TV18 on all of our digital platforms.